The real cost of living off dividends explained. Are you dreaming of living off dividends? It sounds like the ultimate financial freedom, passive income without selling assets. But is it really that simple? In this video, we'll break down the true cost of living off dividends, from taxes and inflation to market risks and portfolio size. Stay tuned. The idea of living off dividends is a dream for many investors. It promises financial independence, passive income, and the ability to sustain a comfortable lifestyle without selling assets. However, achieving this goal is not as straightforward as it seems. While dividends provide a steady income stream, there are significant financial, tax, and economic considerations that affect their sustainability and real purchasing power. This article delves into the real cost of living off dividends, exploring everything from portfolio requirements and taxation to inflation and market risks. Understanding dividend income. What are dividends? Dividends are payments made by companies to shareholders, usually derived from profits. They can be issued as cash payments, additional shares, or other forms of compensation. Companies with strong earnings and stable cash flows often provide dividends to reward investors. Types of dividend stocks. Blue-chip stocks. Large, established companies with consistent dividend payments, e.g., Johnson & Johnson, Coca-Cola. High-yield stocks. Stocks that offer higher than average dividend yields but may carry greater risk. Dividend aristocrats. Companies that have increased dividends for at least 25 consecutive years. REITs, real estate investment trusts, businesses that must distribute a large portion of profits as dividends. MLPs, master limited partnerships, often found in energy sectors and provide tax-advantaged income. Calculating the portfolio size needed. Living off dividends requires a well-structured portfolio large enough to generate sufficient income. Several factors determine the required portfolio size. Determining your annual expenses. Before estimating the necessary portfolio, one must calculate annual expenses, including housing, rent, mortgage, maintenance, healthcare, food and groceries, transportation, travel and entertainment taxes. If a retiree needs $50,000 per year and aims for a 4% dividend yield, they will need a portfolio worth $1.25 million, $50,000 per 4%. Dividend yield considerations. Low-yield portfolios, 1–2%, require substantial capital, e.g., $2.5 million plus for a $50,000 income. Moderate yield portfolios, 3–4%, a more attainable target for many investors. High-yield portfolios, 5% plus, riskier, potentially unsustainable dividends. Growth versus income trade-off. A balanced approach involves growth and income stocks. Higher growth companies may have lower dividends but offer capital appreciation, protecting against inflation. Taxes on dividend income. Tax treatment of dividends. Qualified dividends, taxed at long-term capital gains rates, 0%, 15%, or 20%, depending on income. Ordinary, non-qualified dividends, taxed as ordinary income, subject to higher rates. Foreign dividends may be subject to withholding taxes from other countries. Tax-advantaged accounts. Holding dividend stocks in Roth IRAs or 401ks can minimize tax burdens. Example of tax impact. An investor earning $50,000 in dividends may owe 15% in federal taxes, $7,500. Reducing net income to $42,500. Inflation and purchasing power. One of the biggest risks to living off dividends is inflation. If inflation averages 3% per year, purchasing power declines over time. A fixed $50,000 dividend income today may only be worth $37,200 in real terms after a decade. Dividend growth is a hedge. Companies that consistently increase dividends, e.g., dividend aristocrats, help investors combat inflation. A stock yielding 3% today but growing dividends at 6% annually will provide higher future income. Market risks and dividend cuts. Risks to dividend sustainability. Economic recessions. Companies may cut dividends during downturns. Sector risks. Energy and financial stocks tend to be cyclical. High payout ratios. If a company pays out most of its earnings, dividends may be unsustainable. Regulatory and policy risks. Government policies, such as tax hikes on dividends, can reduce net income. How to reduce risk: diversify across sectors. Avoid concentration in a single industry. Monitor payout ratios. Companies with a payout ratio below 60% are more sustainable. Focus on dividend growth stocks. Rather than just high yield, prioritize companies that increase payouts. Keep a cash buffer. Maintain an emergency fund in case of dividend cuts. Real-life case studies. Case study 1. Conservative dividend investor John, a retiree, holds a $1.5 million portfolio with a 3.5% yield, generating $52,500 annually. By investing in dividend aristocrats, he experiences gradual income growth, reducing the impact of inflation. Case study 2. High-yield investor facing cuts. Sarah chases high-yield stocks with an 8% yield but sees dividend cuts during a market downturn. Her income drops from $80,000 to $55,000, forcing her to sell assets. Case study 3. Tax-efficient portfolio management. Mike strategically places dividend stocks in his Roth IRA, avoiding taxes on $40,000 of annual dividend income. Strategies to optimize dividend income. Focus on dividend growth stocks. Companies that increase payouts over time ensure inflation protection. Utilize tax-advantaged accounts. IRAs and Roth IRAs can shield income from taxes. Reinvest during accumulation phase. Dividend reinvestment compounds growth. Avoid chasing yield. A high yield often signals financial instability. Consider international dividend stocks. Diversify across global markets. Keep a cash buffer. At least 1 year's expenses in a high-yield savings account. Living off dividends is an attainable goal, but it requires careful planning. The real cost involves more than just hitting a target yield. Investors must consider taxes, inflation, market risks, and dividend sustainability. By focusing on a diversified portfolio of growing dividend stocks, optimizing tax strategies, and maintaining a financial cushion, individuals can increase their chances of successfully living off dividends while preserving long-term wealth. Thanks for watching. If you found this video helpful, don't forget to hit that like button, subscribe for more investing insights, and turn on notifications so you never miss a new upload. Have questions? Drop them in the comments, and let's keep the conversation going. See you in the next video.